Corporate valuations shift by the second. Financial markets exert continuous pressure on corporate assets, demanding accounting systems that reflect economic reality in real time. When a company buys an ownership interest in another entity, whether that is common stock, preferred stock, or the rights to acquire them, the accounting method hinges on the level of presumed influence. We are focusing strictly on minority ownership interests, where the investing company has no significant influence over the investee. There are exactly 3 exceptions to this rule. Standard equity security rules do not apply to investments accounted for under the equity method, investments in consolidated subsidiaries, or investments where the entity has specifically elected the fair value option. Remove those exceptions, and you are left with passive minority holdings. For these investments, accounting strips away complex ownership formulas and focuses entirely on raw current market value. This brings us to the core mandate: fair value through net income. These minority equity investments must be measured at their exact fair value at every single balance sheet date. It is tempting to treat fluctuations in a stock's price as harmless paper adjustments, safely sequestered away from the income statement in other comprehensive income. Instead, the absolute rule for these securities dictates that all unrealized holding gains and losses bypass other comprehensive income completely. They flow directly into the main income statement. Because these adjustments are recognized at each reporting date, the company's bottom line is immediately impacted by market volatility, even if no shares have been sold. To see this mechanism in practice, consider a case study involving Abico. On November 1st of year 1, they purchased 200 shares of Galeco common stock. Looking at this initial acquisition, fair value is $100 per share, totaling $20,000. On a less side, cash decreases by $20,000, while a new asset, investment in equity securities, increases by the same amount. Liabilities and stockholders' equity remain untouched. At the exact moment of acquisition, the original purchase price perfectly aligns with the market's fair value. Because cost and fair value are identical on day 0, no gain or loss is recognized. By December 31st of year 1, the situation has changed. The stock price has fallen to $90 per share. This updated balance sheet for December 31st details how to adjust carrying value. The $10 per share decrease across 200 shares results in a $2,000 asset drop. The investment is now recorded at $18,000. To keep the accounting equation balanced, the right side must absorb an equal $2,000 drop. That offset is recorded as an unrealized holding loss, reducing stockholders' equity. The strict mathematics of balancing assets against equity force that paper loss out of the balance sheet and straight into the current year's income statement. 1 year later, on December 31st of year 2, the market reverses course. The stock price surges to $115 per share. Examining the table for year 2, a critical rule emerges. The $5,000 gain is calculated by comparing the new $115 price against the previous $90 carrying amount. The original historical cost is ignored. We track a $5,000 increase to the investment asset, balanced perfectly by a $5,000 unrealized holding gain applied to stockholders' equity. By anchoring the calculation strictly to the previous period's carrying amount, the asset's economic performance is isolated entirely to the current year. Prior year data cannot skew the current year's income statement. Severe financial distress does not wait for December 31st. Companies must be prepared to recognize catastrophic value drops between normal reporting dates. This requires a mandatory 2-step impairment protocol. Step 1 is a qualitative assessment. The entity scans for distress signals like deteriorating earnings, credit rating downgrades, or a collapse in asset quality. If triggers are met, the entity performs Step 2, a quantitative test. The carrying amount is compared to the newly estimated fair value. Any excess carrying value is instantly recognized as an impairment loss. Functionally, an impairment loss serves the exact same mathematical purpose as an unrealized holding loss. It tethers the inflated carrying value back down to harsh market reality, pulling the loss through net income. Eventually, the holding period ends and the equity security is sold for cash. This triggers the final phase of the accounting cycle. This standard scenario, detailing Walco's disposal of 2,000 shares of HempCorp, provides the variables we need to calculate a realized loss. The critical starting point is the year 6 carrying value of $29,500. Notice that the original purchase cost of $31,500 is mathematically irrelevant to the sale. On December 15th, Walco sells the shares for $14 each, generating $28,000 in gross proceeds. Subtracting the $1,400 in brokerage commissions leaves exactly $26,600 in net cash. We compare that $26,600 of net cash against the $29,500 carrying value on the books. This leaves a recognized loss on disposal of $2,900. Realized gains and losses are always calculated against the most recently marked carrying amount. This rule ensures that previously recorded unrealized fluctuations are never double counted when the asset is finally sold. From the initial purchase through every paper fluctuation up to the final cash liquidation, every adjustment funnels directly into net income. Any cash dividends received along the way follow this exact same path, reported as dividend income on the main income statement. The fair value through net income model eliminates the illusion of delayed impact. Whether a company simply holds a volatile asset or formally cashes it out, its financial statements reflect the unvarnished economic reality as of every reporting date.